Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and as the year comes to a close, I felt an agonizing reappraisal of one of the most tumultuous years I've experienced in my 20 years covering banks was in order. When I think back of 23, the word unprecedented certainly comes to mind. The Fed's aggressive rate hike campaign pushed bank balance sheets deeply underwater, spurred deposit outflows, and exposed asset liability mismatches at some institutions that culminated in record-breaking bank runs and the second, third, and fourth largest bank failures in U.S. history. Those closures and the liquidity crunch, regulatory response, market sell-off, and eventual recovery that followed changed the competitive landscape and the way we view the industry. I thought it was worthwhile to look back at major highlights of the year and share some of the more insightful commentary from guests on our show, as well as the lessons learned from the fallout and potential opportunities that lie ahead. We came into the year focused on liquidity after deposits had declined in 22, and some investors were concerned that outflows could be even greater as the Fed continued its campaign to fight inflation. Certainly there were a few outliers. Silicon Valley and Signature Bank had seen their deposits decline by several orders of magnitude more than the industry, but in January and February, the street was much more focused on Silvergate, a crypto-focused bank who had faced huge deposit outflows and sold securities to cover the shortfall. We had Todd Baker, a senior fellow at the Richmond Center for Business Law and Public Policy at Columbia Business School and Columbia Law School on the show on March 9th, the day after Silvergate announced plans to voluntarily liquidate its banking operations, to talk about it. It also turned out to be the same day that the unprecedented bank run on Silicon Valley Bank took place. At the time, Baker said that volatility in the crypto business in the aftermath of FTX fall exacerbated problems for Silvergate, but he noted that the situation had some historical comparisons to banks that were heavily exposed to a single industry that experienced great stress.
What happened here, crypto is crypto volatility in the business is the cause, but it's really no different from a situation you might have had in the 1980s or 90s with, an oil patch lender that was over concentrated in oil and gas exploration, or you can think of other examples. It's just a bad idea for a bank to be completely concentrated in one industry. It never works from a risk management standpoint. And it's also bad for a bank to be heavily concentrated in a business that hasn't seasoned itself through a variety of cycles, credit, interest rate, et cetera. And so all those risk factors were present in Silvergate. And it really isn't, about crypto, except insofar as it follows from the observation that crypto is an extremely volatile business. It's the volatility and the liquidity risk management implications of that when you're dealing with a business where you don't have a long track record and therefore your outflow assumptions are always going to be wrong that we're facing here. So it really isn't. What happened here is about crypto, but really isn't about crypto. It's about asset liability management and what the appropriate risk procedures should be in a bank and how much capital should be placed against this.
He further spoke to the situation at Silicon Valley that was unfolding at the time, just the day before the bank closed its doors. He said that Silicon Valley had always had a cyclical deposit base. The difference this time was that they underestimated drastically just how fleeting their liquidity could be.
This bank, which incidentally, back in the 1990s, back when I was a lawyer, I represented them. I was their corporate lawyer. And so I have a fairly good understanding of their deep past. And it's a cyclical bank because it is so tied to the tech industry, in particular what's happening in Silicon Valley, that during boom cycles, it's essentially servicing startups and the venture capital community. And there is a tremendous amount of money being raised and not being deployed all that quickly. And most of it goes into deposits at Silicon Valley Bank. And so during good times, their deposit portfolio grows very, very significantly. And one of the key strategic challenges they've always had is what to do about that. At various times, they thought of it as, how shall we deploy all these deposits into something other than the tech lending that we're doing, which is it's a very important business, but not that large a business. And so they went through periods back in their early days where they invested in winery loans. They actually had a church lending business at one point. The idea being, well, we got to deploy all these deposits. But they always found that when the tech cycle turned, those deposits went away pretty fast. And so the current version of Silicon Valley Bank was focused on, just like Silvergate, on the idea that we had to manage this as a liquidity risk, and we would invest in securities, and so that when inevitably the deposits started to roll off, we'd be okay. But again, they radically underestimated how fast this would happen and how large, as you pointed out earlier, their deposit base. I mean, the current cycle that's been going on for the last 10 years was the biggest ever, lasted the longest, and the deposit balances just ballooned. And I should also say that Silicon Valley Bank has been expanding around the world, and so its place as a tech player is no longer just in Silicon Valley, but everywhere else where tech, VC, and startup activity is strong. So they, the problem, which was always there in the business model, highly cyclical, just became really, really big. And so, what they did here was recognize that in a very a less intense way, they were experiencing what Silvergate experienced, which is deposit outflows and an underwater portfolio. And they decided, because they're a strong player, they could raise equity. They have a relatively diversified business, although very tech focused. So they went out and bit the bullet and sold off all the available for sale securities at a $2 billion loss and raised a bunch of capital. And their hope is they're going to put all this behind them. Their net interest margin will improve because they'll be investing this money at a new rate. And they'll be well prepared for whatever happens in terms of their deposit balances going forward. But they're clearly preparing for an exaggerated version of the cyclical reversal of their deposit balances that they've seen many times before. So making a long story short, your friend was exactly right. That was the risk, and it's always been the risk in this company.
The run on Silicon Valley that occurred that day was larger than anyone had ever seen, with depositors pulling more than 20% of their funds out of the bank in a single day. That's 4 or 5x larger than the previous largest bank run. The bank was closed by regulators the next day, and panic over the safety of deposits at banks tied to the VC, tech, and crypto space followed. That wreaked havoc on Signature Bank, which had a similar run over the weekend, and was closed days later. First Republic also experienced a massive run on the bank, and PacWest and Western Alliance, which avoided full-scale runs, experienced elevated outflows as well. As news of funding challenges spread across the industry, bank stocks took huge hits. By early April, we'd seen the group fall 20% on the year, and some regional banks, First Republic, PacWest, and Western Alliance, had lost more than 45% of their market value. First Republic led the way, whose stock had dropped nearly 90%. KBW CEO Tom Michaud came on the show in early April and told us on April 4th that the market likely will remain choppy as investors wait for more clarity on the economy, credit quality, and potential regulatory changes that we are all expecting to eventually occur. But ultimately, he expected a sharp rally for the bank group because valuations looked incredibly attractive to him.
I have always found that in my career, the number one strategy is to buy the trophies when they're on sale. And there are a lot of really high quality companies and banks that are on sale at the moment. And again, the stocks could be flat for 6 to 9 months, but if you can be a long-term investor, my instincts are these stocks, you'll be happy you bought them 24 months from now.
First Republic ultimately failed, marking the second largest bank failure in U.S. history. J.P. Morgan acquired the failed institution from the FDIC after being involved in the efforts to keep the troubled bank afloat. J.P. Morgan CEO Jamie Dimon, perhaps the most respected CEO in the banking industry, said at the time that the purchase of First Republic marked an end to the liquidity crunch.
No crystal ball is perfect, but yes, I think the banking system is very stable. You guys have reported already on tons of regional banks who actually had good results, very modest outflow. A lot of the deposit outflows because of quantitative tightening. It wasn't because these people are having runs. There are only so many banks that are offside this way, and I think this is, there may be another smaller one, but this pretty much resolves them all. But this part of the crisis is over. That does not, down the road, there are, rates going way up, real estate, recession, that's a whole different issue. But for now, everyone should just take a deep breath.
Still, bank stocks continue to take hits for a few weeks, and liquidity pressures persisted. While generalist investors were running away from the group about as fast as they could, some bank-focused investors saw an opportunity. We had one of them on the show in mid-May, and that was Brad Rinchler and Connor Labazetta at Down Range Capital Management. Connor said at the time that while they saw short opportunities outside of the bank space, they thought the valuations of many other banks were really attractive.
On the short side, beyond a couple special cases, we're not really meaningfully short banks at the moment. The short book currently consists of mostly digital lenders and commercial mortgage REITs. And we see significant deterioration in those companies over, call it the next 12 to 18 months. But the biggest change we've made is we own a lot more banks on the long side than we did 3 weeks ago. We believe that despite the issues we've seen in some of these institutions, the industry as a whole has been oversold.
Around that same time, it was already clear that the banks would face new rules. We hosted a briefing focused on bank liquidity in New York in May, and Isaac Boltanski, Managing Director and Director of Policy Research at BTIG, was one of our panelists. He thought that changes were eventually going to come, but noted that nothing happens quickly in Washington, D.C.
Yeah, look, D.C. does two things well: nothing and overreact. And I think that's exactly what we're going to see here. Congress isn't, they're no longer nowhere on the deposit insurance issue. They're like in a town just down the road from nowhere. There will not be a bill to address and expand deposit insurance. It's not going to happen unless things get much, much worse. And part of the reason for that is just normal political nonsense and all that, but also just think about the way that a bill would come together. You would have Democrats who say, hey, if you're addressing that, I want to also address CEO comp, right, which is a big issue in the hearings that we've heard. And the Republicans would say, hey, I also have some qualms with ESG. I want to make sure that that's in there. And before you know it, it's overburdened and it falls on top of itself. There are, and we can talk about this, and I hope we do, I think there are some red lines to be aware of, and really here we're talking about volatility in banks that have a clear political constituency. You know, I look at a bank like Regions where, look at their footprint. It's in red states and it is numerous states, whereas I have had staffers say to me, why are we going to do a deposit insurance bill for a couple failures of what are coastal niche banks? That's where the conversation is right now legislatively. So it's got to get much worse before you see action there. On the regulatory side, this is what's wild about it. They were already gearing up to tighten the regulatory infrastructure around banks, right? We already knew they were going to go after super regional banks with the TLAC rule and the single point of entry. Now, on top of that, we're going to have Basel III finalization, and then the third bucket, which we'll talk about later, which is what they're going to do to respond to this crisis. And here we're talking about AOCI and LCR and all that. That's happening. And what makes this interesting, I promise I'll shut up after this, what makes it interesting here is DC's not going from 0 to 60, right? They were already starting to get a sprint because, you know, look, Vice Chair Barr from the Fed was talking about at least starting the super regional side of this to begin with. This has just given them more momentum to accomplish that. So nothing in Congress unless it gets much, much worse. Regulators are where it's at. And really the fight is going to be on implementation timeline for some of these items. When we talk about AOCI, when we talk about LCR, even stress test changes, that's where the fight is, because there will be a change. It's just how long do you have from an implementation timeline?
Other panelists said that they had already seen changes during regulatory exams. Bill Burgess, co-head of financial services investment banking at Piper Sandler, said at the event that regulators have begun testing banks against new liquidity ratios.
The regulatory changes are already underway. The OCC was sitting down with national banks in early April, like the first week of April, with a new ratio of liquidity and cash as a percentage of uninsured deposits, a ratio that didn't exist on March 1st. And they want that ratio at 100%. So you're going to see more securitizations. I mean, they're already reacting pretty aggressively to what transpired. And they're not going to wait for regular way changes to approaches for banks overall. So I think they've been nimble after they got caught completely flat-footed. And we'll have to see how that develops over the course of the coming months. But ask any OCC bank in particular, and you'll see there was a sharp change in attitude in April. And I think that was probably a good thing to get people ready for what could come.
Another panelist, Ben Azolf, a partner at Luse Gorman, said he had seen examiners subject banks to more matters requiring attention, or MRAs, and even subjecting the more serious orders like memorandums of understanding or MOUs, as well as higher capital requirements.
I mean, we're definitely seeing just a general, much like the other panelists said, intensity in the regulatory environment that was starting and has definitely continued. So things that were MRAs are now, you're seeing, discussions of MOUs, or even things like individual minimum capital requirements, which are often confidential, so you won't necessarily know that publicly. They'll be put in place so that if a bank is having, say, risk management issues or things with the regulators, they'll make them hold heightened capital, even if their capital actually objectively is okay, with the concept that, if there's these issues here, they need to retain more capital. Even in the environment that we've been in, we've seen all sorts of what I'll call sort of almost regulatory sort of fiats. I mean, one thing that's happened over the last month, we've seen regulators coming asking, particularly in the community bank spaces, for daily liquidity reports. I've had several clients, and again, who I'm not sure where the line is, but looking at uninsured deposits and saying, hey, we need liquidity reports. Even an earnings call with the banks, getting together the finance team to answer the regulators' questions, almost like you'd have as an analyst, but not really. Questions like, why do you think your stock price is down? If they knew that answer, they wouldn't be there. They'd be in Hawaii, right? So, a lot of questions, but a lot of fear that's there, and we're really seeing that in the regulatory environment right now. So we're going to see rule changes for sure, but I think even at a more granular level, you're just seeing regulators interacting with the banks in ways that we just haven't seen, prior to this crisis. And how long that'll continue, I don't know. But it even goes so much that, you take all this attention, and that's even impacting M&A, like application processing, because you have case managers at the FDIC, whoever, who are inundated with all of this day-to-day work, which they didn't have before. So it is definitely a highly unusual environment at the moment.
Not long after that, regulators eventually unveiled their long-awaited new capital proposal, dubbed the Basel III Endgame, in July. It was estimated to increase common equity Tier 1 capital requirements by 16% for the impacted banks, those over $100 billion in assets. Banks and trade groups staunchly opposed the proposal, arguing that it would hurt credit availability and only benefit non-banks. And we hosted a webinar in December talking about the implications of the rule. One of the questions we got from a number of listeners was asking if they were, one, the rules in response to what happened in March, as well as if they were in reaction to the so-called tailoring of large bank regulations that occurred in 2018. They asked if those tailoring rules, which lifted the asset thresholds for some regulations to 250 billion assets, above the size of some of the banks that had failed at the time, played a role in the failures themselves. One of the presenters on the webinar, Luigi DeGinghi, a partner at Davis Polk and a veteran regulatory counsel, pushed back against that argument.
Bottom line, no, I don't think so. There was nothing in the tailoring rules to encourage banks to forget all about managing interest rate risk, or that it was a good idea to invest in long-dated, fixed rate debt securities at a time when inflation was going up, and therefore it was entirely predictable that the Federal Reserve would have to raise interest rates. Nor did the tailoring rules suggest that it was a good idea to operate without a chief risk officer for a while. Nor did the tailoring rules suggest that it was a good idea to try to reclassify AFS debt securities into HTM, that you wouldn't have to run AOCI through the impact on HTM. Because let's not forget that even if the AOCI opt-out disappears under the Basel III Endgame proposal, the only thing you recognize in common equity Tier 1 capital is unrealized gains and losses on AFS debt securities. It has nothing to do with held-to-maturity securities unless you fair value your HTM portfolio. And you're not required to fair value your HTM portfolio under U.S. GAAP. And the tailoring rules didn't say anything about developing huge concentrations in uninsured deposits to a fairly concentrated deposit base consisting of portfolio companies of a concentrated group of venture capital and private equity firms. So, no, I think that's a complete red herring, frankly. And particularly since the risk that really developed for the banks that did fail was a combination of liquidity and then interest rate management failures. Frankly, it's hard to see how the Basel III Endgame is really going to solve that. And in fact, the Basel III Endgame was not meant to solve that. Basel III Endgame proposal was meant to implement all of the revisions to the Basel framework that the Basel Committee laboriously worked on for about the last 5 or 7 years. The real fixes, if you will, to what happened at SVB and Signature Bank and First Republic I think, fall into a number of different categories. One, there's got to be better supervision, better management by some of the banks themselves, including interest rate management. Better supervision by the banking agencies. The banking agencies have this rule that say, breakneck growth is a clear red flag. Well, Silicon Valley grew very, very quickly at breakneck speed. That should have been a red flag to the banking agency. Didn't seem to be. And then there's liquidity. You could certainly revisit some of the liquidity risk stress testing requirements. You could revisit the LCR and the NSFR, but those are not part of the Basel III Endgame proposal.
One common theme through 23 was that the prospect of greater regulation could actually lead to a thawing of the nearly frozen M&A market. Notable deals were really few and far between in 23, but the PacWest Bank of California deal certainly stands out. PacWest was one of the embattled banks during the height of the liquidity crunch and took a variety of actions to shore up its funding base, but ultimately agreed to merge with Bank of California. The deal marked the largest of the year, and at the time offered some hope that a rebound in M&A could be in the offing. But advisors even then acknowledged that the transaction was unique because PacWest was a motivated seller and the deal was seen as a solution to regulators. It also had PE involvement, with Warburg Pincus and Centerbridge helping fill the capital hole created by the required rate marks on the deal. PacWest was also the accounting acquirer because it was larger, which reduced the hit from those marks. At the time, Matt Vanieri, the head of investment banking at Janney Montgomery Scott, thought that the deal could mark a start of increased M&A activity, but still thought there was a long way to go.
It's unique, and so I don't think you'll see this structure replicated a lot out there. But as far as this transaction, the transaction that took place on the same day in Virginia, and then just knowing the conversations across the board that are going on, I think that this might be the start of a increase in activity. We've got a long way to go before I'll call it a wave, but we're starting to see a lot more communication going on between parties, transactions that were in various stages of process in the first quarter of the year that are starting up again, and discussions are being had again. And so that's going to lead to more activity. And as we get more data points post early March and see what the market value proposition is, you're going to see an increase in activity. That's how these waves start. We have to do a little bit more price discovery where the sellers can understand where the market is, as well as the buyers. And then as that increases, we're going to see that wave build. And I do think as we go into next year, as the interest rate environment settles out, you're going to see more activity, just given some of the headwinds in some cases, but also the tailwinds in others of what's going on in the banking sector right now.
That call proved true. M&A activity remained very depressed through 2023, even as bank stocks recovered, though we did hear plenty of more talk about private equity lining up and trying to get in on the action and help facilitate more transactions. It's kind of astounding that bank stocks have recovered as much as they have. The investors we spoke to who saw opportunities were right. In fact, many regional banks are set to end the year flat after being down dramatically earlier in the year, which is pretty astounding. But multiples remain low, and the bigger hurdle remains the capital hit associated with deals. Piper Sandler's Burgess said in late November that most discussions in the bank sector currently revolve around capital and a potential restructuring of balance sheets, because higher rates have pushed loans and in particular bonds deeply underwater. In fact, when you mark publicly traded banks' balance sheets to market, Burgess said the median reduction in the tangible common equity at the time was 42%, huge hit. And that left many deals capital hungry.
And right now, it feels like everything within the bank space revolves around either capital or balance sheet restructuring. Evan reminds me of movie quotes. But there's a quote from a movie, maybe you remember this one, called Fletch, where he says, "Oh, come on, guys, it's so simple. Maybe you need a refresher course. It's all we meant to say was balance sheet restructurings nowadays. Everything today is revolving around bank capital. Either it's an institution that's trying to find capital to tinker with its own securities portfolio or its own balance sheet, and finding ways to improve the capital ratios. In the bank M&A world, kind of the topic of this podcast, it's how do I find the capital necessary to facilitate a transaction that I want to pursue. It could be through third-party sources. When we sold PacWest, not only did we have to find a creative structure where we marked the smaller balance sheet versus the larger balance sheet, we also had to find third-party capital. It could be in the case of Eastern, where they had in their sights a terrific franchise, but it was on our top 200 list. It was number 4 in terms of no capital on a mark basis. How do you buy an institution that has no capital? Well, we were able to sell Eastern's insurance business at 35 times earnings, book a gain, and boom, there's your ability to facilitate an M&A transaction that you find strategic. That's the third-party capital for that. In the case of the FDIC needed to find a way to sell Signature Bank and Silicon Valley Bank. And on the sell side there, we didn't have to worry about the capital because it was being provided by the FDIC fund. And that's what enabled New York Community and First Citizens to pursue those transactions. Everything requires capital. And if you're a seller that's trying to find your way through a balance sheet restructuring, either you raise capital, which no one seems to want to do, or maybe you find an acquirer with sufficient capital to restructure your balance sheet for you. And we saw that most recently with a transaction between Old National and Capstar. So everything is capital today in the M&A world, and M&A and otherwise. It's all about trying to find a way to restructure your balance sheet if you believe that these current market rates are going to persist. If you think that the Fed's going to go back to a quarter basis point and cut rates by 500 plus basis points in the next 6 months, well, then all bets are off. But no one thinks that. No one should expect that. And now everyone's trying to find a way to improve their net interest margin, to improve their profitability by either large restructurings funded with capital or smaller incremental marginal transactions to slowly improve their profitability.
Since that recording, we have seen many more banks reposition their balance sheets and expect to see more of those announced during fourth quarter earnings season in January. 2023 was a wild year, and there will likely be plenty more action again in 2024. Happy New Year to all of our listeners, and thanks for tuning in again.